it's very unlikely that further banks will fail. That there are two reasons. One, the main reason why banks are failing in US. Say, for example, actually the story of Signature Bank and story of Silicon Valley Bank was very different. In case of Signature Bank, it was that they were speculating in cryptocurrency, which in itself is a very risky business, and they eroded capital and subsequently it went bust. But in case of Silicon Valley Bank, there was no such problem. The problem was different. Here what happened is that they saw huge increase in their deposits, which jumped from say $60 billion in 2020 to $180 billion in 2022. The reason for that, startups used to bank with, particularly the Bay Area in California, they used to bank with Silicon Valley Bank. And the startups were in flavor during the pandemic. So they mobilized a lot of fund which was parked with the Silicon Valley Bank. Now Silicon Valley Bank obviously could not make so much of credit in that short period. So they are holding a huge amount of securities. They are holding almost 60% of their assets in securities. And these are mostly mortgage-backed securities and government securities. Now when the interest rate started falling, obviously they started booking, interest rates started rising, they started booking mark-to-market losses. Now since Silicon Valley Bank was less than $250 billion asset bank, they didn't need to make unrealized provisioning for unrealized mark-to-market losses. So that loss was accumulating in their portfolio. But suddenly what happened is that since major part of the deposits of the Silicon Valley Bank was more than $250,000, now the deposit insurance in US, the upper limit is $250,000. Now since they had more deposits on the higher end, in fact 94% of their deposits are more than $250,000. So a large part of their deposits are not insured. So those depositors felt that Silicon Valley Bank is going down, and they started withdrawing deposit from the bank. So it was a classic run on the bank, and they had a withdrawal requirement of almost $42 billion. Now to meet that requirement, they started selling securities. Now when you are selling securities, you are realizing the losses which were sitting in your book earlier, and that eroded the capital of Silicon Valley Bank. Now, in response to that, the Fed and other authorities in US, they did two important things. First, they sort of guaranteed all the deposits of Silicon Valley Bank and Signature Bank. So there was no longer a requirement for the depositors to withdraw deposits. So that run stopped. The second thing what they did is that they opened a refinance window, whereby now these banks could basically mortgage their securities and get money from the Federal Reserve. And on the top of that, what they did is that while taking the money, it was not on the depleted value of those securities, rather at the face value. So they are not making any mark-to-market losses any longer while mobilizing fund. So these two steps, that guarantee for all deposits of the failed banks and at par borrowing against the collateral of securities, these two things stop the run on banks. Now going forward, I think because of these steps, it's very, very unlikely that similar kind of run is likely in any other bank.